feel about
Volatility is your friend. I have a shirt and it says embrace volatility. Because again, this goes back to Markowitz theory. And again, he won the Nobel Prize. It's not me making this up. What you want is a collection of the highest volatility assets that are uncorrelated. Amazon.com and Bitcoin have the exact same volatility, 80. This is amazing. Wow. Amazon's been a public company for 27 years. In every single year of those 27 years, they've had a double-digit drawdown.
Bitcoin prices recovered briefly to begin the week, climbing from last week's lows of $58,252 to the $64,500 level on Monday. However, the leading crypto asset struggled to clear the $65,500 resistance zone. Prices dropped below the $63,000 level on Tuesday before bulls again tried and failed to capture the $65,000 resistance zone. The leading crypto asset is currently trading below $63,000, with an immediate resistance near the $63,350 level. It faces another key resistance above the $65,000 level, especially around the $65,500, which has proved to be a major hurdle for bulls. A clear move above that resistance level could send prices higher past $66,000 and towards $68,000 per coin. Despite being in a bull market, the cryptocurrency market has been experiencing quite a bit of turbulence lately. However, expert analysts and other prominent personalities in the space continue to assure investors that volatility is a huge part of the experience. According to renowned hedge fund manager Mark Yusko, Bitcoin investors should actually seek and welcome volatility instead of running from it, as it is a huge part of the cryptocurrency market. The drawdowns and price declines may be brutal, but they are needed to achieve the upside rallies we've all come to love and enjoy. During a recent interview with Jim Friend, host of the Advancing Our Church podcast, Yusko discusses his outlook on the cryptocurrency industry in 2024 and beyond, describing why he believes Bitcoin is a better investment asset, especially compared to other asset classes including stocks, bonds, and cash. As we bring you clips from the interview, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks, and enjoy the video.
Zero exposure to this technology, this innovation, was wrong. Well, why was it wrong? Look, I've been around a super long time. Just, lucky, fortunate. And I've seen every attempt at diversification. Like when I started in the business, I am this old, it was frowned upon for fiduciaries to own stocks, right? Remember the cover story, 1979, death of equities. No self-respecting fiduciary should ever own equities again because the market had been dead money for a decade from 68 to 79. People were fed up and they're like, just own bonds. And then ERISA came along and said, no, you really need to own stocks. And then you got to own international stocks. And then you got to own hedge funds and private equity. And this all came to Markowitz, who I fortunately got to study under at Chicago, great blessing. And Dr. Markowitz won the Nobel Prize for saying, when you take cash, the riskiest asset you could ever own, he said, no, it's the safest. Oh, no. It's the safest in that you don't lose anything. But every day, the Fed is stealing a little bit of your wealth through inflation, so you're getting less rich. So if you start with cash and you add bonds, which bonds can default, they have risk, that portfolio is actually less risky. When you add stocks, risk goes down. When you add international equities, risk goes down because they're uncorrelated to one another. But here's the problem. All these uncorrelated assets that follow Markowitz diversification, they're kind of uncorrelated. Stocks and bonds are 30% correlated, international stocks 60% correlated, small cap stocks 80% correlated, value and growth 85% correlated, hedge funds 70% correlated. So yes, they do lower, like if I had real estate or hedge funds or private equity, I do lower the risk, and Yale, Princeton, Stanford, Harvard have mastered this. Same with Notre Dame. But here's the thing. Bitcoin is not only the best performing asset over the last 15 years, it's also the lowest correlated asset. It has 0.0 correlation to bonds. What does that mean? All that means is that if bonds go up, you don't know what Bitcoin's going to do. If bonds go down, you don't know what Bitcoin's going to do. They're totally uncorrelated. Doesn't mean negatively correlated. It doesn't mean one zigs when the other zags. It just means there's no information content in what bonds are going to do and Bitcoin's going to do. And Bitcoin is 0.15 correlated to stocks. So when you add it to a portfolio, the return per unit of risk, the return per unit of volatility, the Sharpe ratio, goes up more than anything else. So if you had just taken 1% a decade ago, right, and put it into Bitcoin, your portfolio, instead of compounding at 9, would have compounded at 11 with less risk. Well, what if I'd taken 2%? Then you would have compounded at 3% higher. What if I put 5%? You would have compounded at almost 10% higher. Now, this is not promissory. That's not saying this is going to happen in the future. But what it says is that we have this asset. And the reason it's uncorrelated is because stocks, bonds, et cetera, all rely on the same thing. They rely on interest rates, GDP growth, demographics, inflation. Okay. Bitcoin doesn't rely on any of that. Bitcoin is all about the digital divide. I tell this time, ask anyone over 35, who's your broker? Oh, I don't know, UBS, Merrill Lynch. Why? How much gold do you have? I don't know, 3-4%. How much Bitcoin do you have? Oh my gosh, 0. Are you kidding me? It's a Ponzi scheme. Haven't you heard that Peter Schiff guy? How often do you use DeFi? What the heck is DeFi? What are you talking about? Okay, ask anyone under 35, and DeFi stands for decentralized finance.
Right.
So ask anyone under 35, who's your broker? What's a broker? I mean, I have a Robinhood account. Okay, how much gold do you have? Whoa, are you kidding me? Boomer rocks? 0. Haven't you heard that Peter Schiff guy? How much Bitcoin do you have? I don't want to talk about it. Why not? Because it's like a really big percentage of my net worth. I'm kind of embarrassed. How often use DeFi? Every day. So that digital divide is real.
One important event Bitcoin and crypto investors are looking forward to is the announcement of rate cuts by the U.S. Federal Reserve. Last week, Bitcoin got a boost from Fed Chair Jerome Powell's considerably dovish remarks, as the Fed Chair reinforced plans to announce rate cuts at some point before the end of the year. While speaking at a press conference following the FOMC's May meeting, Powell said, "We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment." Powell also noted that more rate hikes are very unlikely, a statement the market took as further assurance of rate cuts before year-end. Bitcoin and other risk assets reacted positively to the news, indicating that there will be massive price gains when the Fed finally begins cutting rates. According to Peter Brandt, a popular full-time commodities and foreign exchange trader with decades of experience, Bitcoin is currently going through a common bull market continuation phase. In a post made on social media platform X, Brandt wrote, "If Bitcoin can hold these lows and move higher, the chart will qualify as a very common bull market continuation chart construction." Let's get back to Mark Yusko's interview as he speaks further about volatility and its importance.
Volatility is your friend. I have a shirt and it says embrace volatility. Because again, this goes back to Markowitz theory. And again, he won the Nobel Prize. It's not me making this up. What you want is a collection of the highest volatility assets that are uncorrelated. Like if you want to minimize your volatility, put it all in cash, which is the dumbest thing you could ever do because you'll wake up with less wealth because inflation will steal it all away. So you can buy something that's a little more volatile, bonds, and maybe you can keep up with inflation. You can buy a little more volatile stocks. But here's the myth about volatility. Volatility is not risk. Volatility is simply disagreement about the future prospects of a business. So I'll give you an example. Amazon.com and Bitcoin have the exact same volatility, 80. This is amazing. Wow. Amazon's been a public company for 27 years. In every single year of those 27 years, they've had a double-digit drawdown, including this year. Okay. On average, 31%. Meaning, on average, you lose a third of your money every year, in theory. But when was the right time to sell? In fact, twice you lost more than 90%. But when was the right time to sell? Well, never. Well, who bought Amazon.com on the IPO and held it to today? There's only 5 people. Jeff, mom, dad, ex-wife, Bill Miller. Bill Miller's cost is 7 cents, right? It's 100. Actually, no, it's less than that. It's 0.7 cents because just did a 10 for 1 split. So 0.7 cents, and it's worth $177. So he was the only one that got that volatility didn't matter. What matters is the long-term accumulation of the network value. Same thing with Bitcoin. Bitcoin is the best performing asset over 1, 2, 3, not 3, 1, 2, 4, 5, 10, 15 years. 3-year number is not very good because there's been volatility. But that volatility corrects itself over a long enough time horizon. There is no 4-year period in which the return on Bitcoin is negative. None in 15 years. And that volatility is a feature, not a bug, because it's uncorrelated with the other things in your portfolio. So the thing about it, I was on CNBC back in, I think it was 2018. And the price, while it was on the show, went from about 10,000 to 8,000, right? So it dropped a lot. Like in the 6 minutes, which I wasn't even on the show for very long, but in the 6 minutes. And Melissa Lee looks at me at the end and says, so what should we do? I'm like, well, buy it. She says, well, you'd always say it. You'd say if it went to 5,000. I was like, yeah, buy it today, buy it tomorrow, buy it next week, buy it next. Don't buy it all at once. Buy some today. What Bitcoin is, it's the perfect savings technology. It's deflationary money instead of inflationary. So whereas every dollar I get paid for doing my job, converting energy to value, the government slowly steals it back from me. Over a 30-year period at 2%, they take half my purchasing power over a 30-year period. That's crazy, okay? With Bitcoin, every dollar I save in Bitcoin over the 15 years has gone up in value, but it actually hasn't. This is the genius of it. One Bitcoin is one Bitcoin, but we don't price Bitcoin in Bitcoin. We price Bitcoin in dollars, right? So the dollar has been getting less good.
Still on Bitcoin's volatility, senior Bloomberg ETF analyst Eric Balchunas recently revealed important information about the spot Bitcoin ETFs. According to a post he shared on Monday, all spot Bitcoin ETFs recorded inflows to begin the week, an unexpected event considering last week's sudden price drops. Eric's post reads, "First time ever 1D flows all green, no red for the Bitcoin bunch. Not going to spike the football like some did during the outflow period, but will point out that over 95% of the ETF investors hodled during what was a pretty nasty and persistent downturn. Will the same happen next time? Who knows, but the track record says it will be a pretty high percentage again. As we said, outflows will happen, so will inflows, but over time, 2 things tend to be true for ETFs: net growth and relatively strong hands." Eric's post will shock many critics of the spot Bitcoin ETFs who previously questioned how the boomers would react to Bitcoin's sudden 30% declines. These investors are mostly used to the mild volatility of the bond and stock markets. However, as Eric has stated in previous posts and interviews, they might be able to stomach Bitcoin's high volatility better than expected since they only have a small percentage of their portfolios allocated to BlackRock's IBIT and other spot Bitcoin ETFs. In a follow-up tweet, Eric shared a chart of Grayscale's GBTC spot Bitcoin ETF, describing it as borderline art. The post reads, "This chart is ETF Hall of Fame level, borderline art. I've never seen anything like it, and probably never will again." Regardless of what's coming, Eric expects the boomers to hold steady, with the expectation that prices will recover and climb even higher before the bull market ends. Do you agree with his analysis? Please share your thoughts on Mark Yusko's interview and Eric's post in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.